Hey everybody, Charlie Dobbins here for another version of the group coaching call for the Masterclass Elite program. This is in addition, also if you're an Owner Forum member, you also have access to the Elite program as well. We just had our mastermind call with other members of the, oops, let me fix that, with other members of the first Owner Forum group, and we it was great. We had about 6 people all on video conferencing talking about deals that we're all working on. And the whole objective behind the Owner Forum is to get you to make offers and get you to own a property, which is why we're doing this, right? So let's do this. Now, tonight is going to be kind of an open forum, kind of free form. If you have any questions, type them into the question box here. We're going to play Stump the Professor. I've actually, obviously kind of prepped the whole thing so that I have a couple of questions already lined up from students of mine that they've been sending in over the course of the week. These are typical types of questions I get, and I want you to see them, and if you have any questions about them, now is the time to do it, and I'll show you how I answer the question. All right, so disclaimer, got to say it, as required by the Massachusetts Bar Council's Office of the Massachusetts Board of Bar Overseers of the Commonwealth of Massachusetts. I'm a lawyer. I'm not your lawyer. Get a lawyer. Best money I ever spent. Hire my friends. Okay, anyway. All right, and also if you have any questions during the course of this discussion, please feel free to type them into the question box on the GoToWebinar section, and I will answer them. All right, so first question. How can I find out rent comps in a particular area? This question was asked of me, and I thought, oh my gosh, I can't believe that you folks don't know how to do that or where to find them. There is a website. Of course there's a website. It's a very, very simple website. It's called rentometer.com. It's great. You just put in the address for the property, you put in the rent, and you hit enter. And that gives you a little meter, red if it's too hot and green if it's just right, and I think yellow if it's too cold. So that tells you if your rent is in the market or not. Free website. Takes you 2 seconds to get this information, but it is incredibly helpful as you're doing your analysis. I used that on a call the other day, and people were like, "Wow, that's fantastic!" And geez, I didn't realize that people didn't even know about that site. But go check it out. You'll enjoy it, I promise you. All right. Okay, broker says he has a lender that will underwrite properties on a T3 income and a T12 expense. Now, for those of you that are pretty new and you don't know what these numbers or codes reference, when you're talking about an income and expense statement, you call it a trailing 12 or a T12. And that means that the income is spread out over 12 months. You get to see all the income every single month for 12 months. And the expenses are spread out over the same 12-month period. So your income and your expense period match up. Except some brokers will decide, well, I'm only going to use this 3-month income period and then multiply it by 4 to get 12 months. And then I'm going to compare it to this trailing 12 section for expenses, and I'll match them up, and there you have it. There's your NOI. Folks, just think about it for a second. Could you do this with the IRS? Like I had a terrible 2010, but I had a really good year this past year. So can I take my expenses, because I spent a lot of money this past year, can I use those expenses against my income in 2010 and then tell the IRS, oh, tax me on this net income? Of course not. I'll be going to jail. But brokers do this type of thing all the time, and it drives me crazy. Now, there's a reason why they do it. Obviously, they want to make the property look as good as possible. But if a property has just gone through a massive lease-up, well, then, of course, the most recent 3 months of income is going to match and look better and be more indicative of what the income is going to be going forward. But what they're not taking into consideration is the fact that you can't take the last 12 months' expenses on a property that has gone through a lease-up and think that those expenses are indicative of what you should expect going forward. I mean, just think about it. If the guy went through a massive lease-up, 12 months ago there was nobody on the property, and this month they're at 100% occupancy. So I'm going to use the income for the last 3 months to show you what you can be making on this property. But I'm going to use the expenses dating back to 364 days ago, and back then nobody was living here. So how much water did you use? How much sewer did you use? What were your utilities 12 months ago? Ridiculously low, not even exemplary of the property. So you can't do that. So if a broker says, hey, don't worry about it, I got a lender that's going to underwrite the properties on T3 and T12, do you say that's good? No. I don't care what the lender's going to do. I care about what the business that I'm looking to buy is going to do. And that's all I care about. And if it's a good business and a good property, then every good underwriter lender will underwrite the property. But if it's not, I don't even want to touch it. If the numbers don't make sense, why even bother? So if the broker says that, tell a broker, nah, not doing it. I want my T12's income and expenses. All right, next question. Is a repair allowance a common request in an LOI? Not if you're one of my students. Not on your life. Don't even bother doing this. I'm telling you right now, because this is going to be a big mistake on your part. The fact of the matter is that you want to be able to go back to the seller after you've done your due diligence and see if you can get more money. If you ask him for a repair allowance even before you've seen the property, and then you see the property and realize, oh, wow, that repair allowance I asked for is not enough. I'm going to have to go back to the seller and get more. He's going to look at you and say, why? What are you talking about? I already gave you the repair allowance. Don't ask for any more. Let's close this deal. And right away, you've lost one of your best bargaining chips for more money or revised price. So don't ask for the repair allowance in the LOI phase. You'll look like you just got out of some short guy's boot camp. All right. I know you're all trying to figure out who I just referenced. Anyway, here's a question. If we are syndicating, do we need a goal of no less than 10% cash on cash return, or should it be higher? The fact that you're syndicating has nothing to do with what your cash on cash return should be, okay? If you have one partner in a deal, it doesn't mean that you shouldn't have any type of an investment goal. The fact is that you need to know before you go into this property exactly what should be done when it comes to your investors. Now, if it's a solid, 2-cap property that is safe, secure investment, over 10% might look kind of suspicious to grandma who only is looking for safe, secure investments. So you need to understand when you're looking at these deals, what type of return are my investors looking for, and go out and find a deal like that. And not every investor wants to get over 10% cash on cash return. Sometimes they're looking for a slow, steady, stable 5% return, but just make sure that it's a good quality asset. So make sure that, don't think that because I'm syndicating, I have to get a certain thing. Or I know that there's another guy out there that teaches, the Holy Trinity. Where you got to get double-digit numbers on everything, on your cash and cash return, on, oh boy, what else? Maybe your cap rate. I know that I can't even remember what the Holy Trinity is, but the fact is it doesn't matter. It doesn't work. It's not the way you should be investing. Each deal should be looked at specifically and uniquely, and you shouldn't say the only deals I'm doing are this type of deal. It doesn't work that way. So, next question. Do we use a cap rate that we think the market bears, or the one that the broker is using? Well, fact is, you want to use the broker's cap rate, and you want to use it against him. So that if you look at a particular property and the broker says it's a 6 cap, and at a 6 cap and that NOI, the price is $1 million. And then you go and do your due diligence and you find out that the NOI was bogus and it's a heck of a lot lower. Then it's easy for you to go back to the seller or the broker and say, hey, listen, you told me this was a 6 cap. I only do deals on 6 caps. My investors only want 6 caps. And now after I go back and take a look at it, here's the actual NOI. So if I take this property on a 6 cap with this NOI, it automatically changes your purchase price. And therefore, Mr. Broker, I'm going to have to go down. And all you did was use the broker's cap rate against him. So that's how you want to use a broker. But listen, this particular question has come up quite a bit recently with a lot of my students. If you're looking at a particular marketplace, you had better darn well know what that marketplace does for a particular cap rate on nice assets. You better know what they're trading for in that marketplace. Otherwise, you are going to be bamboozled by every broker around that you can think of. So know the market, know the information about your market, and know it better than anybody else. Okay, and then you never have to worry about what the broker is blowing smoke up your skirt by giving you some fake fraudulent cap rate. And believe me, I see that all the time. Brokers are crazy that way. So anyway, okay, the property has a loan that must be assumed with 3 years left in the term. Good deal? Bad deal? Should I do it? My answer is no way. Don't do it. When you buy a property, you really want to make sure that the finances are in place and set right when you buy it, so that you're not having to refinance a property 2 years down the road or 3 years down the road. Typically, when you go out and get a new loan, you're looking at a 7-year term to a 10-year term, and that's fine. You get to work that property, you get to really make it fly, and you get to put your imprimatur on that deal. If you buy a property today that has to be refinanced 3 years from now, man, you've got no honeymoon period. You got to get in that property and start working towards that refinancing right away. That's not a good position to be in. So if I see a property that I have to assume it's got less than 3 years or less left in the term, forget it. I'm not buying it. I don't want it. Let somebody else have to deal with it. I'll come back in 3 years when this guy's refinancing. Is insurance income an operational item? The reason why this question came up is I was actually doing a presentation last weekend here in Boston, and we were looking at the financials on a particular property. And you look at it, and there's a section on there for the insurance income, and it's above the line. And I think to myself, okay, so that is above the line, and usually the reason why insurance income is not good income is because it's non-recurring, and it is typically set off by a corresponding expense. So we looked at this financial statement, and if you looked in the expenses, there was no insurance expense item. But if you went and looked below the net operating income line, there was your insurance expense. So essentially what this guy did was he took the insurance income of about $50,000, and he took that and he said, okay, I'm going to go up on this income. My NOI is going to go up based upon this insurance income by $50,000 with no corresponding operational expense. And at a 10 cap, that means I just increased the value of this property by $500,000. And if you don't understand financial statements, they're going to run circles around you every step of the way. So make sure you understand that and know what you're doing. All right. Oh, that was it. Let me see if I got any questions. I think it's a pretty light night tonight, which is great. It's a beautiful night out. We can all take it easy tonight. Yeah, so we'll just kind of bring it in for a landing here. Hey, guys, listen, I've got a due diligence seminar coming up on the 26th to the 28th of June here in Boston. Make sure you go check it out and register. You can get there by going to the multifamilyinvestingacademy.com/due diligence. Or mfiamasterclass.com/due diligence. I only wrote down one of them, but you can also go to the MFIA Masterclass, which is where most of you guys are members of anyway. And I'm actually going to put that on the website so that if you want to sign up right from the membership site, you'll be able to do that. So, hey, everybody, I hope this was helpful. Just a quick and easy little group coaching call. And hopefully next month, hopefully next in 2 weeks, the group coaching call will be an interview with another one of my successful students. We're waiting for this deal to close, and as soon as it closes, they will come online and give us a good, the bad, and the ugly report, which is what I love to hear. So, all right, everybody, hey, have a great night. Always a lot of fun, and I'll chat with y'all later.